So is the market going to continue to go up and start to make new highs again? Or is it going to start to come back down and maybe even possibly go even lower, becoming a market crash? So this is the million-dollar question, and I'm pretty sure you want to know as well, right? So why am I asking this question? So the reason I'm saying all this right now is because I've actually had quite a number of people that have reached out to me to ask this very question, especially somewhere around here when the market started to come down and they were a little bit worried. So they asked me, Davis, do you think the market is going to go down even further? Is there going to be a market crash? And if so, what can we do to protect our portfolio? So I think the last question about asking, what can we do to protect the portfolio if the market crash is actually a very good question. And that's what I really want to address inside this video, is how you can protect your portfolio in the event the market actually goes down. So in order to answer this question, I want to share with you a slide over here, which is just part of a training which I get all my mentorship students to go through inside my mentorship program. And it's a very important training that they must understand even before they start to place any trade. So as you can see over here, this is on the winning mindset of successful options traders. So over here, I list 3 important points that is very important that I feel every option trader should really understand. So the first point, you can see that I mentioned that the successful options trader relies on statistics to trade objectively and not base his or her trading decision based on emotions, fear, and greed. So I'm sure that you may have certain option positions right now whereby maybe it's going against your position. The market has started to come down quite a bit and you're worried that the market may even crash. So you might be tempted to just get out of this trade. So whether you actually get out of this trade shouldn't be a result of your emotions, shouldn't be because you're feeling fearful that the market is going to go down. That's why you decide to cut it. But instead, you should be basing your decision based on what you've already known of the strategy and the statistics. So for example, if your strategy is to exit at, let's say, expiration or maybe at 21 DTE, you should stick to that regardless where the market is going, because if you already have studied your strategy and you have seen the statistics, especially some of the statistics that I've shared on my channel in my videos, then you should be confident going forward, knowing that even though if there's going to be a crash, you know that there will be losses here and there, but over the long term, as long as you stick to the way that you're trading, statistics have already shown that you have a positive edge. So we shouldn't be managing our position based on our emotions. Now, second thing is that the successful options trader understands that no one can predict where the market is going to go and doesn't try to. So the question, if you're asking as well, Davis, do you think the market is going to go up or is it going to go down? This is a pointless question because the answer is, I don't know. And nobody else knows as well. And if somebody can tell you with 100% certainty that they know where the market is going to go tomorrow or in the next 1 week, then I would suggest you to be very careful or wary about what that person says. So to ask that question, where you think the market is going, is actually the wrong question. But a good question to ask is actually to ask, what should you do with your portfolio if the market actually goes down? That means to say, this shows that you are actually planning beforehand. You are preparing for the event if the market actually crashes or go down, and you already have strategies or positions in place to capture that move down. So that's where this third point comes in, where the successful option trader does the planning before he or she enters the trade and already knows well in advance what he or she will do when the market gets there. You already have a plan in advance, not because you see the market is crashing, you're starting to get emotional, you see the loss start getting bigger, then you want to exit that. That is always the wrong decision. So when you're already well prepared, wherever the market goes, all you got to do is simply execute your plan. In short, you must have a plan for whatever scenario the market can give you. So especially the worst case scenario, which is most of the time a market crash, which is what many people want to avoid. So this is a quote by William Eckhart, who is featured in the book Market Wizards by Jack Schwager. If you haven't read that book, definitely give it a read because it's a very good book to understand the mindset of some of these traders. So William Eckhart had this quote inside this book where he says, don't think about what the market's going to do. You have absolutely no control over that. Instead, think about what you're going to do if it gets there. So again, this is all about preparing in advance. And when the market actually goes to wherever it goes, you already have a plan for it and you just execute it. So now on to the question. So how can we actually prepare our portfolio in the event the market actually is going to go down or there's a market crash? So I'm going to go through a few option strategies where you can use to actually help protect your portfolio. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So the very first strategy I want to share with you would be the plain vanilla put option strategy, basically to just buy a put. So let me just go to use this option down here, the 45 DTE one. Now, in the event the market actually is going to crash, there's going to be a very big move down, then the best way to really protect your portfolio is in the form of buying a put option. This is the most plain, simple way to actually protect your portfolio to the downside, because if the market actually goes down, you can make more as it goes down. So if I was to show you the P&L graph down here, you can see that just by simply buying a put option, you have kind of unlimited profits to the downside all the way down to 0. So at the same time, if the market goes up, you are also protected. You don't lose infinite amounts. So there's always a cap to how much you can lose. So if there's going to be a market crash, the simplest way to protect against this market crash would be buying a put option. However, buying a put option can be quite expensive. So as you can see over here, it costs you on SPY about $11.89, which is about $1,189. So if I was to hover over here, you can see the max loss down here is about $1,192. Right? So give and take around this price. So that means to say, if the market doesn't crash, it goes up, then you lose about $1,000+ at the end of this 45 days for this DTE interval. So this is actually quite a hefty amount, but if you think, it's a good amount to pay to protect you on the downside, then by all means, you can use this strategy. But you just need to know that this is for every 45 days. That means if the market doesn't crash in the next 45 days, you're going to pretty much lose this money if the market goes above this strike price. Now, the other way that you can actually protect for a longer time period is to go for the longer dated options. So for example, you can go one that is about, let's say 367 days out, which is about a year out. Now, if you were to protect your portfolio about a year out with a put option, you can see that it starts to get even more expensive, right? So if I was to buy this, let me just cancel the previous one. So let me just delete this. You can see that this costs you about $30.45. So that is about $3,000 for this put option. So it is quite expensive as well. So the other way is by buying a put debit spread. So let me just go back down to the 45 DTE again. So let me just open up this option chain. So instead of buying a put option outright, what you can actually do is to sell a put option further out of the money. So this way, at least you make it cheaper. So let's say, for example, we go for a 10-point wide put debit spread. So what you're going to do is you just sell the put option down here. And here you have a 10-point wide put debit spread, which is going to cost you much lesser than a put option. So as you can see over here, it only costs you $3.37, which means to say your max loss is about $300+, right? As you can see on the right hand side, the max loss is $337. So it is going to be slightly more cheaper compared to buying a put option. But the drawback of this put debit spread is that if the market actually goes past this point, so as you can see down here, this is where we sold the put option. So this is our strike price, somewhere at 573. So if the market actually goes past this point at expiration, then you're not going to make much more than what you already have gotten at this point, because you have already sold the put option down here, and this kinds of already caps the max that you can make. So this is for the put debit spread. So both are very viable, and both are actually a way that you can hedge your portfolio in case the market actually goes down. Now, one of the things to understand is if you are planning to do this strategy on SPY, you need to realize that SPY is actually what you call a positive drift vehicle. which means to say over the long term, the market wants to go up. So if I was to go back to SPY, you can see that SPY has always been making new highs, right? As you can see that SPY has been accepted for many, many years. And over time, it just kept making new highs. And if we were to see the statistics, the market actually goes up more of the time than it go down. So that means to say that if you were to consistently use the put option strategy or to use the put debit spread, over time, this can be considered a losing proposition because the market keeps going up. So when you're paying for these strategies like the put option and the put debit spread and the market actually doesn't go down, then you're actually going to lose money. So what are the ways that you can work around this? So one way that you can work around this is to actually finance the purchase of this strategy with another option. So in this options world, we call this financing. So there are a few ways that you can do the financing. So if let's say, for example, you want to purchase this put debit spread, there's $3.37, but you want to use another option to finance this, then one way that you can do is simply sell a put option to finance the purchase of this put debit spread. So right now, as you can see, the cost of this put debit spread is $3.37. So what you can do is you can go to the put option that is further out of the money and then find the put option that is roughly around this price. So let's say, for example, I was to go for this one down here, 544 strike price, and I was to sell this put option. What will happen is that now I will receive $3.41 in terms of credit, and then I use it to purchase the put debit spread. And I still have a spillover of 5 cents. That means now I have a 5 cents credit for putting on this strategy. So if you were to take a look at the P&L graph down here, you will see that it has this structure over here. So on the right hand side, what you essentially have is the put debit spread. But you notice now there is no loss to the downside down here. There's no loss. Previously, there was this zone down here where it's in the red, but now it's no longer there. So let me just remove this. And it's no longer there because you use this short put at the bottom, which is at 544, to purchase this. So right now, if the market goes up, there no longer is a loss because everything has been paid for by this short put. So in the event, if the market doesn't actually go down and it continues to go up, then there is no loss to you. Now, although you have already financed the purchase of this put debit spread, you also need to understand that now there's still some risk to the downside. So as you can see over here, past this break-even point at expiration, you're going to start to lose money. So this is one of the trade-offs of using the financing option. So if you're financing with the short put, although there's now no risk to the upside, you have now shifted the risk to the downside. So let's say, for example, there really is a market crash, and let's just say the market crash is very severe and it goes all the way past your break-even point expiration, then this is where you can start to lose money. So while the market can come down, you can profit in this zone down here. We just don't want it to go too far down. So this is where you can also strategically pick your strike price down here. So let's say, for example, let me just remove all these drawings and remove all these strikes as well. So let's just say, for example, you choose the $10 strike price. So right, if you choose the $10 strike price, it just means that the market has about a 10% chance of it going past this strike price at expiration. That means to say 90% of the time, it will be above this strike price. So if you feel comfortable with this strike price and the probability that it will stay above the strike price, what you can do is use this short put to finance a put debit spread. So from here, what you can do is you can choose a debit spread of at the money. So what you're going to do is you're going to buy this strike price. And let's just see how wide of a put debit spread that you can go for where you can still get an overall positive credit. So let's take a look at 3-point wide first. So you can see it says minus 1.24, which means to say you actually still have a positive credit on the upside. So in the event whereby the market does not go down and it goes up, you still get some profits, which is in the form of this credit. And let's say if the market actually goes down and you're right that it does stay within this profit zone, right? And it's within the 90% of the time, roughly 90% of the time, it stays above your short put strike, then you're going to be in a profit as well. So in a sense, this strategy can actually kind of have a hedge to the downside and protect your portfolio to a certain extent, right? You can protect your portfolio to the point of that strike price. Again, remember when we are trading options, we are trading probability. So when we are trading probabilities, this is where, taking a look at the delta can really help because it gives us an idea what is the percentage chance of the strike price actually being breached at expiration. So if it says 10 delta, it just means about 10% that it will go past this strike price at expiration. Now, what if you're not comfortable with this short put? Because short put can be a very big loss to the downside, basically unlimited losses all the way down to zero. But you also still want to have a way to finance the purchase of the put debit spread. Well, this is where you can turn this short put into a put credit spread. So with the put credit spread, you're again going to receive some sort of credit. And with this credit, you can then use to purchase the put debit spread. So how you want to do this similar as well. So let me just remove all this strikes first. So let's just say at this point of time, maybe you're very confident that it won't go past maybe the 20 delta strike price. So that means to say you're okay with the fact that 80% of the time is going to be in a profit and 20% of the time there's going to be a loss. So let's say, for example, we choose 554. What we can do is maybe you can stretch it to about, let's say 10 points wide in this case. So if you stretch to 10 points wide, you're going to receive a credit of about $1.20. Now with this, you can use to purchase the put debit spread. So let's say, for example, I'm going to choose maybe 1 point wide and see what we get. Okay, so as you can see down here, if you purchase a put debit spread that's 1 point wide, then it's going to be very similar to the structure you've seen earlier. But then down here, you have a limited loss. As you can see, your loss is capped to 819. So in the event whereby, it doesn't stay within this profit zone, this max profit zone, and the market actually crashes, then one thing at least you will feel not too worried about is that you already have your max loss cap at this point. So if your max loss is at, let's say this point, $819, even though the underlying goes to zero, you don't have to worry because you're not going to lose all that you have in your account. The only amount you're going to lose is what you risk for this trade. So if you're not comfortable with the undefined risk version of this strategy, you can go for the defined risk version of this strategy. Now, what if you're the kind of person whereby you do want to go for the undefined one, you are a little bit more aggressive in your risk, but you feel that, the earlier strike price that we chose, the 10 delta one, is still a little bit too near where the current market price is. You want to go one that is super far out of the money, right? So I'm sure you have seen some of those videos whereby people go very, very far out of the money, whereby they think that the chances of getting hit is going to be very low. So first of all, I don't really like this strategy, but I just want to just share with you because this is something that some people have actually done. So what they did is that they will choose an option strike price that is super far out of the money. So let's say, for example, we choose one that is maybe around 480. So that is 3 delta. So that means to say there's only a 3% chance of the market going past this strike price at expiration. So what they do is this. So if you can see this, if you were to sell just one put option, you're only getting 82 cents. And 82 cents is not that much because if you want to construct the put debit spread, maybe you may not have that wide of a put debit spread. So for example, if I was to construct this put debit spread, you can see that I only can get a 2 points wide. And then the risk reward down here is not that good because what's happening down here is that you are only going to get a max profit about $205, but your loss is going to be super big. As you can see, if the market continues to go down, it goes past the strike price which you have down here. So what some people actually do is that they want to increase this put debit spread, but in exchange to trade off, what they do is they sell multiple contracts of this put option. So let's say, for example, if I sell 2 contracts of this 480, now I'm going to have more credit. And with this more credit, I can purchase a bigger debit spread. So as you can see, I still have additional 88 cents in terms of credit. Maybe I can stretch it about 4 points wide or maybe even 5 points wide. Can we do 5 points? No, we can't do 5 points. So we can only do about 4 points. How many points is this? 5792583. Yeah, it's about 4 points out. So as you can see, your max profit is higher, but again, you take more risk to the downside. So in case by now, if you haven't realized, this is actually a pretty popular strategy amongst a lot of the traders, which is what's called the 112 strategy. So the 112 strategy is pretty much crafted this way, where you sell 2 put options to finance the purchase of 1 debit spread. So I personally do not really like this strategy because it's a little bit too risky for me, especially on the downside, whereby if the market actually does crash, I'm not comfortable with the loss on the downside. So for me, the most I would go, if I want to use this strategy, I'll probably just use one short put where it's at least closer to where the current market price is compared to the two contracts that's further out. Okay, so this really comes down to your own risk preference, and you have to decide for yourself which one you feel more comfortable. Now, there's one more strategy that I want to share with you that can really help protect your portfolio to the downside, especially if you really have some existing shares in your portfolio, and that is with the strategy that's called the collar. So if you're not familiar with the collar, basically, first of all, the criteria is that you do need to have 100 shares of the underlying. So let's say, for example, I have 100 shares on SPY. What I'm going to do is I'm first going to sell a covered call. So let's just say, for example, I want to sell the covered call at 590. Now, once I've already sold this covered call, as you can see over here, I'm going to receive a credit of about $9.96. And if you've learned anything from this video so far, and that is the concept of financing. So with this $9.94 I received as credit, I can actually use it to finance the purchase of a put option to help me protect my portfolio or the underlying to the downside. So since I received about $9.96, I want to find the put option that is roughly around this same price as well. So as you can see, I can purchase this 577 strike price for $9.75. So when you do it this way, what happens is that if the market actually crashes, let's say the market goes all the way past 577, you will actually not lose more than this strike price that you have already bought down here, this put option down here, because it has already limited your downside. So this is where you really don't have to worry about a market crash because you're kind of already protected to the downside quite a bit. Now, there's a drawback to this strategy because it's always a trade-off. Because remember, you have this covered call down here. That means to say if the stock actually does not go down and it starts to go up, and maybe it even rallies. It rallies all the way up, maybe past to 600 plus over dollars. Well, guess what? You won't be able to participate in the up move because you've already kept yourself with this covered call down here. Now, of course, you can keep rolling and rolling up and out each time you're being tested, but there's going to be a limit to how far you can actually roll. But with that said, the collar can actually be a very helpful strategy, especially if you're worried about a market crash. So if you're worried about the market going down or even a market crash, then you can consider using some of the strategies I've shared in this video. Remember, we do not want to predict where the market is going, but instead, we want to just prepare our portfolio in the event that actually happens. So this way, if the market really crash, you already have some positions in your portfolio that can help you capture the move to the downside and protect your portfolio. I hope you found this video helpful, and if you have, I would greatly appreciate if you give me a thumbs up on this video and also subscribe for more videos like this, and I will see you in the next video.